Another key theme that's in focus is the oil and gas sector as a whole, and we're now joined by Mr. Prabal Sen, Senior Research Analyst of Indian Oil and Gas Sector of ICICI Securities. Mr. Sen, thank you so much for joining us today and for waiting by as well. I just wanted to start with your outlook on the Q3 earnings of some of these major players. BPCL, HPCL have come out with their earnings. How do you see earnings specifically, and then we'll get into the sector, but what is your analysis of the first numbers that have come in for these companies?
So I think this quarter has obviously been a mixed bag. If I look at OMCs on the one hand, on a YOY basis, obviously the earnings looked pretty decent. But on a quarter-on-quarter basis, obviously the impact of much lower GRMs, as well as a decline in blended retail margins, plus the accumulation of LPG losses, all of them weighed a little bit on the earnings. But really, I think in the gas space, the picture was completely different. The deallocation of APM gas for the priority segment in successive cuts over October and November obviously weighed pretty heavily on the numbers. You saw pretty sharp margin declines across the board for the three companies. So in that sense, obviously it has been a little bit of a muted quarter, but really I think the investor focus pretty quickly has shifted to what can happen over Q4, and there I guess the prospects definitely look a little bit better. GRMs have improved even though marginally from the lows that they hit by the end of the third quarter, albeit they are still pretty low at between $1.5 to $2. I'm talking about Singapore margins. But with crude having actually stabilized, the specter of inventory losses might not actually be as significant. Plus, marketing margins have obviously gone up as crude prices have again moderated to a certain extent. So retail fuel margins have once again, improved a little bit. So to that extent, there is also a small probability, even though the budget didn't have a provision, but the oil minister came out and stated afterwards that there could still be compensation provided towards at least a part of the LPG losses that have accumulated through an off-budget provision, similar to what was done in FY23. So you put all that together, at least the OMCs definitely look at a more optimistic, situation for Q4. Similarly, for the CGDs, the fact that in January, about 18 to 20% of the cut that was put in place over October and November was reinstated to a certain extent, and LNG prices have then softened as the winter season has got over, both in terms of spot LNG prices and because of the decline in crude prices. You've got term LNG prices that have also softened a bit because they're obviously linked to Brent crude. So Q3 probably was weak, wasn't the greatest of quarters, I would say. But I think prospects for Q4, at least at the margin, look definitely stronger than they did even about a couple of weeks ago. So that's probably how we are looking at it.
Right. Probably multiple points that you've mentioned right now, from the impact of Singapore GRMs to the way earnings have panned out, and lastly with regards to no LPG compensation, which in turn would come through. However, taking the current scenario into consideration and the kind of losses that have mounted, and if you have to look at FY25 as a whole, are you expecting the profitability to be hit, and if yes, to what extent?
Oh, there's no question that FY25 profitability will be much lower. FY24, if you remember, was actually record earnings specifically for the OMCs, given the huge trend that they saw in GRMs, and marketing margins were also at a fairly decent levels. So to that extent, definitely FY25 would see a decline. But having said that, it's basically about what the earnings would be with relevance to or relative to what the street is looking at. And there, as I said, I think Q4 might still spring a little bit of a surprise, because as of now, our sense would be that, given the disappointment that the budget didn't have a specific provision for it, there could have been a little bit of cuts across the board in terms of earnings expectations. So if that happens, that can be a positive surprise.
So Prabal, are we saying that the pain will continue in FY25, but the setup with regards to 26 and 27 is absolutely set to improve, though the crude oil prices, the upside will remain capped?
No, I think with respect to the crude oil prices, what you're looking at right now, the only bullish trigger, if I can really look at it, is if the geopolitical risk premium really starts to rise over the next 6 to 12 months. If you look at what the physical market is telling you, prospects for demand growth in crude oil actually look pretty moderate compared to the supply increase that can come through. And I'm not just talking about the OPEC plus supply cuts being unwinded from April onwards, assuming that they stick to this current schedule, but it's also because you've got new supply sources coming up all the time. You've got Guyana, which could become a major supply source. You've got Argentinian crude, which is starting to pick up. We recently had news that, from a slightly longer term perspective, Iraq, after probably a decade of stagnation, is putting in place investment plans to increase its crude production from the current, I think, 3 million barrels or to almost 7 million barrels a day. BP has just announced a decade-long $25 billion capex plan to reinvest in the Iraq Kirkuk and some of the other fields. So there is supply that is available, and when you contrast that with the fact that demand for fossil fuels continues to see downward pressures across the developed world and even in China, I think from a pricing perspective, India being a price taker can actually benefit as long as crude remains in a narrow range or is basically at a range of between $70 to $80, which is what looks to be the case. So I would be optimistic from a retail margin perspective. And at the same time, however, if crude remains in a relatively narrow range, your GRMs also tend to settle down or normalize at a level of somewhere in the $4 to $5 range. Where I'm talking again about Singapore benchmarks, which is pretty decent to support earnings growth for some of these companies. So that's basically how we are looking at it at this point of time.
Got that way, Mr. Sen, and you did make a few important points. GRM to be stable, and India could benefit from what's happening in the global market as well as because we have done previously been benefited from as we did in the Russian oil. My just one question was on how are you seeing the current regime change in the United States and with new tariffs coming in on oil from Canada, from Mexico as well as from China. Any outlook that you have? How big of a contribution or how much focus should we put on the export markets as a whole?
Yeah, I think commenting on the US tariffs is a little bit difficult right now. The only thing I would say is, historically, when you have had these kinds of tariff wars, is probably too extreme a word, but this kind of a tariff dispute and uncertainty about what the global trade situation is going to be, that almost always has a negative impact on overall crude demand. So that was my limited point, that you have limited triggers that are there as far as crude demand growth is concerned, while supply could yet remain comfortable. Even if you factor in the efforts by the developed nations or NATO, including US, to stifle Russian and Iranian crude, even then, you have the OPEC plus supply cuts that are being unwinded to a certain extent from April, and you've got additional supply sources. So the physical market, I think, remains probably balanced or weights slightly in favor of supply, which is probably a positive, from both marketing margins and steady GRM perspective for Indian players. That was my limited point.
So Prabal, all in all, a FCF recovery could be expected in FY26. That's a question. And if that is so, between the three, if you're talking about HPCL, which is actually moving closer to a capex completion, so the FCF is at an inflection point. You have a BPCL, which is probably below, the valuations are below historical mean. And you have an IOCL, which has clearly underperformed the other OMCs. So the risk reward over there is appealing, right? Where would your bets be in pecking order then?
No, I think you summed it up nicely. HPCL, BPCL, and IOCL in that order. IOCL, I agree that valuations are probably lower than what they should be. But having said that, IOCL still has a very significant capex program coming up, while at the same time, its refineries continue to remain a little bit vulnerable, because if you look at the complexity profile of the overall refining portfolio of all the three companies, HPCL is the one that stands out at this point of time, with the improvement in Vizag coming through and the residual upgrade project also likely to be commissioned in the next 6 months, and the addition of petrochemical capacity at the Vizag expand or the Rajasthan refinery expansion project also coming through by the end of next calendar year, or this calendar year rather. So their portfolio, I think, continues to get more complex, and their business mix, I think, continues to become more balanced, with the capex cycle already over to the extent of maybe about 60-70% of what they had planned. So I think from a balance sheet perspective, they probably appear much better. And if earnings uptake actually does come through, or as a result of slightly improving margin scenario, I do believe HPCL stands out as probably the most preferred pick. BPCL after that, primarily because it has a fairly resilient refining portfolio compared to the other two players, and even with the capex coming through, it still manages to keep a pretty strong balance
Right.
sheet over the next couple of years.
Right. So clearly HPCL, BPCL and IOC in the pecking order. That's what Prabal is looking at as well. Thank you so much for joining us on the show.